Hello and welcome to Money Maximized. Today we are going to talk about significance of liquidity ratio. Liquidity ratios are financial metrics that provide insights into a company's ability to meet its short-term financial obligations using its readily available assets. These ratios are essential for assessing a company's liquidity, which is the ease with which it can convert assets into cash to cover its immediate liabilities. One of the most common liquidity ratios is the current ratio, which divides a company's current assets, such as cash, accounts receivable, and inventory, by its current liabilities, including short-term debt and accounts payable. A current ratio above 1.0 suggests that a company has more assets than liabilities due in the near term, indicating a healthy level of liquidity. Another key liquidity ratio is the quick ratio, or acid test ratio, which provides a more conservative assessment of a company's short-term liquidity by excluding inventory from current assets. It measures the ability to meet obligations without relying on potentially slower-moving assets like inventory. Liquidity ratios are crucial for evaluating a company's financial stability, its ability to manage day-to-day operations, and its attractiveness to lenders and investors. These ratios are instrumental in strategic decision-making, risk management, and maintaining financial health. The significance of liquidity ratios lies in several key areas. Financial stability assessment. Liquidity ratios are crucial for evaluating a company's overall financial stability. They indicate whether a business has enough readily available assets to meet its short-term obligations without resorting to external financing or selling long-term assets at a loss. Operational efficiency. A company with strong liquidity ratios is often better positioned to manage its day-to-day operations efficiently. It can pay suppliers, employees, and other creditors promptly, maintaining positive relationships and reducing the risk of disruptions in the supply chain or operations. Creditworthiness. Lenders and creditors use liquidity ratios as part of their assessment of a company's creditworthiness. A high level of liquidity can make it easier to obtain loans or credit lines at favorable terms because it indicates a lower risk of default. Strategic decision-making. Liquidity ratios influence strategic decisions. For example, a company with ample liquidity may be more confident in pursuing growth opportunities, making strategic investments, or weathering economic downturns. Risk mitigation. Liquidity ratios help companies prepare for unexpected financial challenges or economic uncertainties. Having sufficient liquidity can act as a buffer against downturns, allowing the business to continue operating even when faced with reduced revenue or unexpected expenses. Investor confidence. Investors use liquidity ratios as part of their analysis when considering investments in a company's stock or bonds. High liquidity ratios can instill confidence in investors, indicating that the company is financially stable and less likely to experience financial distress. Working capital management. Liquidity ratios are vital for assessing working capital. A company's ability to maintain a healthy level of working capital, current assets minus current liabilities, is essential for day-to-day operations and growth. Financial health benchmark. Liquidity ratios provide a benchmark for comparing a company's financial health over time and against industry peers. Consistent monitoring of liquidity ratios can reveal trends or anomalies that may require further investigation. Common liquidity ratios include the current ratio, current assets divided by current liabilities, and the quick ratio, current assets minus inventory divided by current liabilities. These ratios offer varying degrees of conservatism in assessing liquidity. In summary, liquidity ratios are significant because they serve as important indicators of a company's financial health, operational efficiency, and ability to manage its short-term financial obligations. They are valuable tools for decision-making, risk management, and maintaining financial stability. Thanks for watching, and don't forget to like, share, and subscribe.